Dan Ives is here at Post 9. We know that Tuesday is going to be a big day. You say the clock has struck midnight. And the line that stuck out to me, trading in the Model 2 for Robo would be a tragic gamble, in your opinion.
I think it would be a gamble that could maybe even define the future of Tesla next 3 to 5 years. And I think right now the big nervousness is Model 2. That's a key part of the growth. That's 50 to 60% of the incremental growth next 2 or 3 years. Robotaxi's autonomous. That's not for another 5 to 6 years. And I'd say, look, we've seen over the last decade, we've been through a lot of white knuckle moments from Musk and Tesla. This is up there. And this has really been a Cinderella story that in the near term has really turned into a nightmare on Elm Street. It all starts next Tuesday. Needs to control the narrative, because if there's no adult in the room, there could be darker days ahead.
So if he really does say, we're going to play this long game, and it's going to come at the expense of the 2, you would re-rate?
That would be, if that happened, it would be a disaster of epic proportions. Because in the near term, and you've seen others throw in the white towel because of the fears of that and because of some of the stuff that's reported, that would really put a massive black hole or gap in the growth for the next few years. And if you look at the last sort of 2015, 2018, there were levers that Musk could pull and ultimately did pull. And that's why it's, you've seen the history. But this I'd say for the first time in 5, 6 years, long-term Tesla bulls are really calling, feels like they're about to hit the elevator if they don't hear what they want on Tuesday.
Why are analysts like you and investors so downbeat on the prospect of the Robotaxi future?
Bullish on Robotaxis, bullish on autonomy. The problem is this would be like Cook on May 2nd, coming out and being like, okay, iPhone 15. Now look, we're not going to have anything till iPhone 21. But trust us, thanks for being on the conference call. So that's the problem, is that we're bullish.
It's always worked for him before.
Exactly. And I think now the difference is you need a refresh. Competition comes from all angles. Game of Thrones that we're seeing in China. And the credibility for Musk has definitely been questioned, because the last 2 conference calls we've talked about on the show, those have been train wreck horror shows. So it all comes down to clock struck midnight. Tuesday night, adult in the room needs to step up, navigate the story, and that's why we call it a fork in the road moment. We are still bullish on the long-term Tesla story, but this is a Category 5 storm, and the pilot on the plane can't be Ted Stryker.
But what do you? There's a lot of just analogies and stuff there. But what do you want to hear? Because the China competition is not in Tesla's control.
Yeah, you need to hear 4 things. 1. What's the growth strategy in China? How are we going to reverse the trend that we're seeing in mainland China, which has been, we'll call it 60, 70% of the growth, incremental growth story for Tesla.
How do they do that? Those cars are cheaper. They're nice. I saw them on the streets. I tested them. How are they going to reverse that kind of growth trend?
Hold prices, hold margins. We're going to basically bet on our brand, no different than what Apple has done. And I think many others, including Microsoft, depending on the products. But give the strategy there. What are the targets? And Sarah, they have to give guidance. What's the targets on growth realistically? What do margins look like? Where does it trough out at? AI, Musk, the 25% threat, recommit, keeping AI within Tesla, showing FSD, showing autonomy. That's been the problem here, is that if you had an adult in the room to navigate, I think 30% of the sell-off here has really been Musk-driven. But it all comes down to, like, you could talk the talk, you gotta walk the walk.
Jeremy Siegel joins us. Professor, do you think it's justified, given what we've seen on rates, on geopolitics, headwinds piling up?
Well, Sarah, we know we had an incredible steady rise from last October, almost record-setting, not a 2% decline. And, that actually is not healthy either, because you get momentum players just jumping on the market. I think a little pullback. And by the way, I don't even think we have a 5%, which is the minimum definition of a pullback. But a little bit of softening is certainly not unhealthy for the market. I think we're going to get a good PCE deflator number next week. Yeah, which I think 2.7% will be the lowest in 3 years. And by the way, that's only 3/10 away from the year-end target that the Fed set in March of 2.4% for that deflator. So I think, yeah, we had three disappointments on CPI. I think PCE will come in, and I think our CPIs are going to start coming in May and June. So, and when we take a look at the futures, we've squeezed down to basically one cut by December. I actually think that we could get more if we get these good deflator numbers and inflation numbers. So I think, you know, I still see gains in the market going forward this summer.
I know that the PCE is the Fed's so-called preferred inflation measure, but the CPI has really captivated the attention of investors and of the Fed. You heard me go through all the reactions of these Fed members. They changed their tune after the March CPI report. So how are they going to explain, if you think they'll be encouraged by a better PCE, which they should be, how do they explain that gap, and how do they convince investors, the American public, themselves, that they're doing the right thing if they're cutting based on PCE? Right.
Well, first of all, the CPI and the producer price index come out a couple weeks before the PCE. So it's the most informative data that economists and the Fed has to predicting that PCE. I look at the CPI much more importantly also. But I see good trends forward-looking in that CPI. For instance, we've talked about the fact that shelter, actually shelter and insurance are more than 50% of the last 12 months CPI core increase. And looking forward, both of those look very much more favorable, particularly the shelter segment, which is 41% of the CPI core. So looking forward, those are very promising and important factors that could suppress the CPI, and that will feed into the PCE deflator.
So your view is we're going to get more cuts now than the market is expecting, and that's a good reason to buy stocks?
Yeah, I mean, I think that now that, you know, we could all say at the beginning of the year the market was overly optimistic with 4 or 5 cuts. Now it's squeezed down to 1. And I actually think that we might get 2 or 3 cuts by the end of the year. I don't think the Fed knows. I don't think really anyone knows. They follow just month by month what the data is. And by the way, one thing that's important that Chairman Powell said, now he said there was disappointment in the CPI. However, he did say we have a dual mandate. If the economy softens, and you mentioned that some people are talking about a softening March, early April, that is another reason for us to cut rates unless inflation is, let's say, out of control. They really have to look at both of those, and I found those words to be very encouraging in terms of forward action for the Fed.
We could go through March, and many of us did, and you did, and said it's not going to be this easy forever. We had no 2% pullbacks, so we were kind of due for some kind of a setback. But what specifically do you think the market's contending with? Obviously, we got the geopolitical headlines, the higher for longer story, and then, you know, maybe just a question about whether this economy can handle what yields are giving it.
Yeah, I think it's a really strange time in the market right now. We've been overdue for this pullback. Sentiment has been stretched. I mean, I've been worried since January. We're finally getting the pullback now. I think you've got a combination of de-risking to some extent. I think you've also got the begrudging acceptance of a hot economy continuing to build, and that's what I'm really seeing in the rotation today. We're seeing secular growth themes getting sold pretty hard. You don't need secular growth as much when cyclical growth is picking up. And, you know, I think I saw today the consensus GDP forecast is up to 2.4%. That's pretty darn close to average.
For the full year?
For the full year.
Yeah.
And in a hot economy, you typically see value and small cap and cyclicals outperform. It's the cool economy that growth and secular growth themes tend to dominate. We're on the cusp of exiting that.
We do have things like banks up today, energy up today, so part of that cyclical value trade. perhaps. I guess the question is, if earnings are going to hang in there in general, do we need any further setback than we've had already?
So to me, a garden variety pullback is 5 to 10%. That drawdown that we had last fall when interest rates were spiking was about 10% on the nose. So there could be a little bit more to go. We've got to watch the sentiment indicators pretty closely, and they've been pretty frothy. So I think it's going to take a little bit of work to really get them down. I don't think you have to turn to an uber bear here as long as we've got the economic tailwinds at our back. The reality is if you see a pullback more than 10% in kind of the 15 to 20% range, that's typically associated with a growth scare. And I don't think we're talking about that right now. So even if it gets a little bit worse, I wouldn't really expect it to go too far below, say, 4,700 or so.
Victoria, your take on, whether in fact the market is telling you either to be more defensive or if it says, look, let's get used to an economy that's just running at a higher metabolism.
Yeah, I think there's a little bit of both built in there. As Lori mentioned, pulling back to kind of that 4,800 level gives us that 10% correction. It's that 200-day moving average for the S&P. So it makes sense that would kind of be the place to go in and start adding. But you look at some of the things we're seeing, you've only got less than 30% of the S&P trading above its 50-day moving average, right? Put-call ratio moving higher. You look at the flows, the volumes of flows into short S&P ETFs, that's increasing. So I feel there is very much a defensive mood around the markets, and so put some defensive into your portfolio. Some of those areas are doing better. Utilities, which typically don't do well in a rising rate environment, but we're seeing it now. Names like telecom, low beta, good cash flow companies, I think, is where you need to park some money right now, because we do think, as we've been talking all year, we do think we're going to see probably another 4 to 5% pullback here.
Those things that you do mention, though, money flowing into short funds and people hedging more and essentially showing some concern, are also the makings of a bounce, right? I mean, that's what you have to watch for.
They are, and you typically have kind of three different elements, right? When you have a complete turnaround here, you have the initial pullback, then you have a bounce, and then the third leg of that stool is you go back lower. So maybe we're getting a little bit of a bounce here. I think you watch discretionary versus staples, watch that ratio, see how that's going to do. It's consolidating right now. If we see that start to pick up, then maybe that tells you you're in that second phase of the bounce.
Kevin, as you look at companies and how they're valued right now and their prospects, do you feel like you're getting more opportunities? Do you feel like the companies are telling you that the outlook is getting better? Or how are you navigating it as, S&P's down 5%, the majority of stocks down a lot more?
Right. I think it depends a lot company by company, which is how we operate. We're very bottom up. But to some of the questions from earlier, the market's been grappling with this. What are rates going to do, which relates to what's inflation going to do. And what was it a few months ago? I think consensus we'd have 7 rate cuts this year. And we're down to, I don't know if it's 2 now or if we're at 0 already. But
2 maybe.
But, I think, I'm not sure we're expecting much in the way of rate cuts this year. So probably a higher for longer kind of environment, which makes things like pricing power really, really important. We tend to gravitate towards those more stable cash flow generating companies, whether they're consumer branded names, a waste collection name. We've got some, names you might call defensive in there, but also a lot of cyclical type names in the industrial area that are benefiting from a lot of the underlying trends.
And having expected to happen either today or tomorrow, top analysts say that the impact is already priced in currently. Bitcoin prices right now, 65,000, moving up even higher. Joining us right now is Matt Hougan. He's a Bitwise Asset Management CIO. Good morning to you. Let's speak about the halving, and let's speak about what you think happens to the value of Bitcoin. Is this a buy the rumor, sell the news situation, or is there something else to think about?
Andrew, good to see you. Glad to be on. I think this is a buy the news event if you pan out long term. If you look historically at halvings, the price action around the halving, if you look out a week or 2 weeks, is relatively muted. But if you look out a year, the Bitcoin price has rallied substantially after each of the past 3 halvings, and I think it will do so again. I think you can overthink this. The amount of new supply of Bitcoin coming into the market is being cut in half. We're removing $11 billion of annual supply. I think big picture, that has to be good for price, and that's what I would expect over the next year.
What do you make of the debate we've been having, and you've probably seen it, hopefully, over the past week, since the retaliatory attack and now this other retaliatory attack overnight? There's been this question about, is it a store of value? Is it a safe haven? What do people do in this moment when there are these geopolitical risks? And what does it say about what the price movement has looked like over the past week and a half?
Yeah, absolutely. There are a lot of cross currents in Bitcoin's price right now. There's ETF demand, there's the halving, there's tax-related selling, and of course, there's these geopolitical events. I think you can try to read too much into the short-term trading activity. It's better to pan out. If you look big picture, it's done a great job of protecting us against inflation post-COVID. I think eventually it will be a good hedge against geopolitical disruptions. But it's a bit too much to ask for Bitcoin to both be a perfect risk-off asset and deliver exponential returns. It's an emerging risk-off asset. When it gets to be fully mature and is a perfect hedge for the events like we saw in Iran and Israel over the past week or so, those exponential returns will be gone. So I think you have to keep that big picture in mind. Bitcoin is still growing into what it will eventually be.
It's also done a good job of protecting the gains that Bitcoin built into the ETF conversions. And so I'm wondering, Matt, a lot of people were already positioning for the next ETF, an ETH ETF, but the VanEck CEO recently said that he thinks that the application will be rejected. What are your thoughts on whether or not that will actually happen? That was the next great catalyst, supposedly, in terms of the next, crypto to see that big run.
Yeah, we have a filing at the SEC right now for an Ethereum ETF, so I can't speak to that specific filing. But I think actually the bigger catalyst is still with Bitcoin itself. The biggest unlock is coming probably in Q3 and Q4 when the major wirehouses turn on access to Bitcoin. So we haven't really even got through the full totality of the Bitcoin ETF launch. I think we will get an Ethereum ETF eventually. I think it'll be, maybe later this year, maybe early next year, and that will be exciting as well. But there's a lot more to come on Bitcoin specifically. There's a lot of reasons to be excited about Bitcoin specifically before we move on to the next thing, which is Ethereum.
Is your sense that it's the ETF where you're going to see most of the action? If you look at what sort of how Bitcoin gets acquired, if you will, by investors, how much of this is going to be the ETF versus the underlying asset, and does it matter?
I don't think it matters, except in the sense that what ETFs have done is they've unlocked the ability for professional investors to access this market. It's very difficult for endowments, for advisors, for family offices to buy buy Bitcoin on an app. It's much easier in an ETF. So I think the marginal new buyers are in the ETF, right? Professional investors control most of the wealth. They've just started being able to access Bitcoin because of this ETF launch. So I think that's where the marginal activity will take place. But of course, you'll see Bitcoin being bought directly as well. Look, Bitcoin is going through both a demand shock from the launch of the ETF and a supply shock from this Bitcoin halving. Those are happening at the exact same time, and that's a really exciting setup for the next year ahead.
Alphabet CEO Sundar Pichai announcing this big company reorganization in a new memo, consolidating teams to help develop AI products more quickly, but he also hinted at a new type of workplace culture for Google. Deirdre Bosa has the details in today's Tech Check. Hey, Dee.
Hey, Carl, good morning. So let me give you a bit of context. Google has really been the poster child of cuddly tech culture, kombucha on tap, masseuses on staff. That's the softer side of it. But also, for many years, it tolerated an openness for employees to bring social, political causes to work, mix ethics and business. Its founding mantra, even a biggest example of this, don't be evil. But we are increasingly seeing a tougher Google and a tougher Sundar Pichai at the top, necessitated perhaps by this increasingly competitive race in AI. Pichai just sent a note to employees outlining how he is going to streamline the business to simplify structure, improve velocity and execution. But the most interesting part of his memo that came at the end of it, he wrote, and I'm quoting him here, "This is a business, not a place to act in a way that disrupts coworkers or makes them feel unsafe, to attempt to use the company as a personal platform or fight over disruptive issues or debate politics." And guys, this was a not so veiled nod to what happened earlier this week. A group of Google employees, they staged a sit-in across a number of Google offices, including one literally inside of Cloud CEO Thomas Kurian's office at headquarters. They were protesting a more than $1 billion Israeli government cloud contract. But instead of hearing them out or dropping the contract like Google did Back in 2018, with the Pentagon AI contract in response to employee blowback, Google instead nearly immediately fired nearly 30 of the employees involved in that sit-in. And Pichai's memo now underscoring this point that this is a business, i.e. don't bring your social causes to work. That is certainly a departure of the Google we've known for the last few decades. To further put this in context, look at Meta's announcements yesterday. It is integrating its AI assistant into its family of apps. It also announced the arrival of Llama 3, the next version of its open source large language model. So the goalposts here, they are shifting very quickly. And Google seems to understand that it needs to get its house in order so that it can keep up or take back the lead, which some feel that it's given up. Now, how it impacts the financials, the stock, the race will be certainly playing out at the top and bottom lines of the mega caps as we have been tracking. And in particular, I will be looking for more of this kind of commentary or hints of a tougher Google, a Google on the offense, which I've been talking a lot about when it reports next week. It's Tuesday. Also, of course, how search, its cash cow, is being impacted by the competition. You can see on your screen, guys, we've got the Magnificent Seven coming up. It is going to be a very, very busy few weeks filled with lots of mentions on their AI strategies and monetization that could once again flip this race.